For anyone who is joining, thanks for joining today's webinar, Market Making Masterclass, How to Win with Market Make from TGE to Liquidity Mastery. I'm excited to have you. I think market making is very much a black box. No one really talks about it, so that's what we're going to do here. I think there's a lot of listing managers out there in here, some projects, some VCs, some guys that want to learn how market making goes. And one funny thing is actually some competitor I saw on the attendance list, which is pretty cool. Let's wait for a couple more minutes before we get started. While we're doing that, what would be cool to do is if you go to the event page on LinkedIn and actually you can show your project in there, what you're doing, so everyone in the space or everyone who's attending can actually see, who is all attending and what are the people doing in the space. It's a way for you guys to connect. We'll reply to some questions in there. And as we go through the webinar, feel free to engage in that in the chat as well. We, the team, will actually reply to it, but also, you guys can engage with each other. Cool. Cool, we're good to go, I guess. Cool, let's get started. So what will we discuss today is how do you pick your exchange listing, actually, which one to go for? How do you make money with a market maker? I think that's a topic that everyone wants to hear. How do you save your project by picking the right market making deal, primarily going into loan option model or retainer models? How do you know if your market maker sucks or what data is not showing to you? And I think an interesting one as well, and this is how I got in the space, is can you be your own market maker? And how do you attract investors with liquidity and why liquidity is actually important? So who are in the room, like I said, leave some comments, share your project, share what you're doing in the comment section on the webinar live page. And let me know what you guys do. We would love to know, but I bet everyone in the room here would actually love to know as well who is all participating, who's joining. And maybe you guys can collaborate on something. I've seen projects, I've seen VCs, accelerators, a lot of listing managers, exchanges, and actually some competitors that are joining today to see how we do the market making. And I actually think that's awesome. So let's see if we can teach them something as well. I am not only looking for people to cheer for us, I'm especially looking for some critical questions and post them in the chat, especially if you don't agree with something. And we have a specific way of looking at market making, how it should be done. But especially when it goes to loan option models, I bet there's people out there that have a different opinion or a different experience. So I would love for them to actually share that with us. What we're all about is, long-term focus, sustainable markets with solid products and businesses behind them. So that's what we're going to focus on here. We're less focused on really getting tokens to the moon. Like, what is the best way to have a project that is actually staying for the long run? Because what we don't want is the initial pump and hype and very soon a drop down. What we do want is a sustainable market that goes up and stays here because an uptrend leads to, actual confidence into the traders and the holders. We've seen so many charts that go up like this. There's too much selling pressure, not enough buying pressure, and they kind of bottom out, the typical crypto chart. And what we want to prevent that. And we hope to give you today some guidelines on how to do that and how to do that properly. Especially right now, I think this is really comes in great, this webinar, because we've seen things with Wintermute, we've seen things with Manta like happening where definitely market makers were involved. And how can we actually prevent ourselves from making these crucial mistakes and for 3 months be okay, but when the tides turn, we actually get screwed over, so to say. So how do we do that? I have to say, if I look at like how we structure this, there's a little bit of like higher level, boring, but I think really important stuff happening in the beginning, and then we go really into some more detail. Well, even break down a loan option model. I have the screenshot of the terms and everything in there. I'll tell you exactly which exchanges I think are important to focus on, and how do you actually do a proper TGE and which exchanges to list on. I think one thing that's interesting is because liquidity is everywhere. I have two outers, right? Like we have, you can rate anything on like how liquid it is. You have on one side very custom machinery that use pretty custom made for you. On the other side, we have Forex. It's going to be very hard for you if you have that custom machinery to sell it because you got to ship it, You got to find a buyer for it, which is not very accessible. He doesn't know what the fair value is, and there might be a lot of paperwork involved. Well, if you have Forex on the other hand, right, like you know exactly where to buy and sell. It's an easy transaction. There's not a lot of paperwork needed. It's just quick, smooth, and fast, and you can do that with millions of dollars in a single click. Even if you look at housing, that's kind of like in the middle, right? Because you know where to find buyers and sellers. But it's not that you can quickly sell a house, on the open market. It's still a lot of paperwork involved, finding the right partner. Is there enough people to buy from me? And I think a really good advancement that the crypto space is making is going to fractionalize housing, right? Like you have a token which represents kind of like a share in the house. You can easily sell on the open market. They basically made the housing market a more liquid market, and that's basically the product that they're having. So I don't want you to think of like liquidity as only assets like crypto, cash, and bonds and ETFs and stuff can be liquid. Anything can be kind of like rated on a liquidity scale, like how liquid is it? Because basically what it means is like how easy can I buy this and how easy can I sell this in very large quantities? And you can rate that. I have mentioned this one, I think, like 500 times. And I think it's really a high level concept that is important that projects should focus on. Like adoption is fundamentals multiplied by marketing, multiplied by liquidity. And as simple as it sounds, it's one of the three that projects struggle with. And it's for them to figure out which one of the three it is at any given point. Well, fundamentals is really, do people really need you? Like, do you actually solve a solution? Or solve a problem? And it's often the project that comes up with this. You have marketing that's done in-house, basically, or you outsource it to an agency. Third one is actually the liquidity. Like, can people actually buy you? And if they all need to be in place, because what happens if you don't have all in place, right? You can have whack fundamentals. This is a 10 out of 10 on marketing, a 10 out of 10 on liquidity. And you're basically a meme token. It can still succeed, right? Like that's what we see on Solana these days, and it's actually going well for the meme tokens. But I don't know if they're going to be around for the very long run. At least the majority might not. If you have good fundamentals, your marketing is not great, and you have good liquidity, people can buy you, people want you and need you, but people just don't know about you. So how do you fix that? Right? Like you got to focus on marketing. If you have a great product, great marketing, but no liquidity, you have another issue because people need you, people know about you, but the moment they want to purchase and participate in your project, they cannot do that with enough capital because there's no liquidity. Again, they all need to be in place, and that's how you become a 10 out of 10 project. So I often talk about a funnel, right? And this also explains why market makers are not particularly the ones to bring in the volume, but it's actually more marketing and the project itself. Sometimes actually the token price is marketing, right? Because if the price really shoots up, more people get engaged. But it's really important that you then convert them down the funnel into actual users later down the line. So the top part is with KOLs. Marketing is important. How do people know about your project? Do they actually know you? Second stage, to actually start to look at your white paper, your Twitter profile, your CoinMarketCap page on how many exchanges you're listed on, the volumes, the TVL log, for example. Once they think, hey, that's good, let's actually go on the exchange and buy. Well, it's a very much an issue that if there's no liquidity, that you've spent a bunch of money on marketing, on moving them down the funnel, that later down the line, they don't have any place to buy or not with enough capital, so to say. And that's where we as market makers come in, making sure that if someone wants to buy $1,000, $10,000, $20,000, they actually could do so. So the questions, do they know you? First one, do they want you? Like fundamentals. And then can they actually buy you? And that's where we come in. That also explains how we don't generate buying activity, but we make sure that if they want to come, if they will move down the funnel, they can actually purchase. And that's the role a market maker has. So liquidity is basically 1/3 the solution. It is not 100%. And we do get that, right? Like that's why a lot of market makers go into incubation and doing marketing as well and thinking about the fundamentals at the same time, because it's just one single part of the equation. I don't want to dive too much into tokenomics, but there's a couple things that I wanted to give you guys when it comes to tokenomics. I think the first one is have a realistic FDV. Like, too many projects want to launch too high, and it's all about, do your fundamentals line up with the price that you're at or the valuation that you have? If that's not the case, you have a hard time going against the tide, and people will dump on you. And it's so attractive to launch too high, but then you get that chart that continues to go down. Well, if you launch at a fair valuation, you launch a bit lower and you get an upwards trend. That's what you want. Ideally, you get the longest vesting possible. Work with the right people that believe and hold. Not with the people that are looking to dump right away, and the people that make some quick buck in a month and want to be rich tomorrow. So I think a really big one is treat your token as a loan. And what I mean with that is, like, a loan means you'll sell a token or you give it to someone, it will come back on the market. So keep that in mind, that tokens are not for free. And by doing this, treating it as a loan, you will build a sustainable business around this, not going to rely on your token as the main source of revenue. So, of course, build out an MVP before you launch and do everything. Build as much as possible, as much traction to actually keep the hype alive, or have enough utility volume on the market to keep your price up and get that nice looking chart that goes up. This is a big one. Everyone thinks about, like, hey, it's a percentage of the supply, 3-4%. That's okay. That's fair. That's the market average. But how much is that actually in dollars? Because that will be coming back on the book later, and you have to absorb. Last one is airdrops. I think the main purpose for an airdrop is making people aware of your project so they will actually start to use it. Ideally, you don't give it to the wrong people, because they will just sell. You give it to people that are actually going to use it. And I even had this idea, like, can you just make a token usable only? Like, so you cannot sell it, you can only use it to actually get real adoption on the market. So build a real business. The token needs to be a solution, and treat the token like a loan. And that's how you build a sustainable business around your project. So why market making? Like, why do you even need it, right? So it's for two reasons. It is, one, you need market making to actually allow people to buy and sell. That's the primary reason. But the second one that's quite overlooked is authority. Like, people do their research and they go to CoinMarketCap and CoinGecko and look at the spreads and the depth, and especially the more sophisticated traders. Well, they'll look at liquidity metrics, or if they go on DeFi Llama. Well, if you look at Bitcoin, like, they have anywhere between 13 million and around 25 million of 2% depth on the market, which looks very solid, right? And I'll go into these numbers in a later section. If you then look at another project, and I blurred out their name, spread of 2.5%, depth, which means that someone cannot even buy $200 of this token on MEXC, and they barely can buy anything on Gate because there's only $50 on the book within a relevant range. Look at the volumes at the same time, 80K, 55K. Well, we understand as market makers that this is just fake. If you're trying to get an investor on board and he looks at this, he will drop off. If you're looking to get listed on a new exchange, he will drop off simply because your numbers don't line up. So again, it's not only so people can trade, but it's also to have good statistics so you build authority and can actually get investors on board that will believe in your token, or get the people that are, you hook on with marketing down the funnel to actually start buying the token. So how does it actually work on an order book, right? So the primary role of a market maker, at least if you hire them like on a retainer model, is filling up an order book with as many orders as possible, close to the price on both sides, so others can trade. And I think especially the last part is really important, is so others can trade. We're just passively with orders in the order book waiting for someone to come and place a market order. And I'll go into the dynamics of how the order book then works. With as many orders close to the price means the more orders you have closer to the current price, the more liquid the asset is, the larger trading sizes people can actually trade. That allows someone to not place a $100 trade, but 5,000, 10,000. Or if you Warren Buffett, it goes into millions or billions of dollars that need to be, going into an asset. And Bitcoin has enough. That's why it could see institutional adoption. For a small cap projects, even about acquiring a 5K investor or like a retail trader that needs to buy those tokens. Well, 80%, if you're an early stage projects, I guarantee you 80% of the liquidity on the book is probably your orders. If you're a really solid project, like a launcher like Sui, like they have massive amount of market makers on board, a lot of traction. Like I think you'll have maybe 10-20% as a market maker that you engage with, and the other might be hopefully organic liquidity or other market makers that you haven't officially engaged. So 20% of the order book might be organic. So who's then controlling in that sense the supply and demand? Is the project itself. So I hope they have enough capital available to keep the market healthy so people can actually come on board. So the goal is, of course, to make sure that you're not 80% of liquidity, but you're 40% of liquidity, because the other 60% is provided by players in the book that just simply want to buy and sell, or maybe another algorithmic trader that comes on board. So it's important to actually measure that, and how we do that we'll touch upon in a later section. If you have any questions, by the way, definitely post them in the commenting section. We will compile them in there, and we'll answer them down the line, which will be good. Or we'll actually answer them as a reply. So definitely take a screenshot, put it in there, and ask the question you want to ask. So how does this work on an order book? Because like as basic as it sounds, like we see people get this wrong. If you buy from someone, hit the market buy button, you buy from someone else. Well, that's someone passively waiting in the order book on the sell side. So if I buy right now, I buy from this person, at the price of 0.06086. If there's no orders in the book, there's no one to buy from. So I will have a hard time buying. But also, if there's not enough orders in the book, and I want to buy, let's say $50, well, I will interact with this price, the price above it, the price above that, all the way up to here until my $50 order is filled, which means I have slippage. I pay more than the initial price that you see here. Well, same as on the sell side, right? But then it happens with the buy orders. You market sell against buy orders in the book. That's how I just. Well, you can imagine if I want to trade $1 million in this market, it's not possible because there's not $1 million in the book. So it's about little baby steps, right? You need minimally $1,500 within 2% of the price. But ideally, you get to like 10, 15, 30, 60, 150K, where you become a more solid project. You can actually start to get real traction on the market. So how do we measure liquidity? And I don't want to, and then after this, we go on like the juicy part around like, market makers and loan option models and really diving into them. But 2% depth in most simple terms is how much can someone buy in one market order or sell. Really important. This is the primary goal of the market maker to maintain. It's not to move the charts up and down to get volume on the book. It's to have enough depth on the book so other people can actually trade, and it's often measured within 2% depth. So this is super important to attract retail, serious retail, and investors. Spread percentage is a simple metric. I call it an additional fee. It's almost like the DEX pool fee that you got to pay. The higher the fees, the less people are looking to trade. If you put a spread of 5%, people lose 5% of value when they buy and sell. This is more important for retail because they generally trade with some smaller sizes, right? And they even can calculate 5% depth. How much depth is there between the current price and 5% above or below? And I call it kind of backstop liquidity. What that means is like if someone really puts like a very large order, how much will it crash the price? And it's kind of like the backup liquidity. Most people don't interact here, but it's just like a safety. So this is really important for investors. They just don't want price to crash. So this one, I think, is the most important. It's our job, again, as a market maker, to fill up these order books so other people can trade, and you measure that within 2% depth. Cool. Up. Good. So what is good liquidity? Got a couple examples here. So quality liquidity is more orders close to the price on both sides. I have here an order book visualization of, let's start with the best liquidity. A lot of orders very much move to the current price. So someone can execute, $5,000 trade or, $100,000 trade quite easily. It's a balanced book as well, right? Like there's a little bit more buy liquidity than sell liquidity. That's great. Well, what we have here is just significantly less liquidity, which means, and deeper in the book as well, you see, less steep. That means that there's generally less liquidity. So here you can trade like $10,000 easily. Here you might be able to trade $1,000. So you might be missing out on some volume, or people actually, investors that want to invest in you. It's decently balanced, right? You see some sell liquidity here, but it's pretty fine. An example here where it's like decent liquidity, so it's kind of like a little bit more than here, but you get heavy sell liquidity. It's not a healthy book as well. Well, it's not always possible to get that. Some people are just looking to sell like significantly more, but the best quality liquidity is this, where you have both. And here we have an example of buy side liquidity, which is better because that means that people are looking to buy. That means that you can also very easily exit without too much slippage. So this is the image that you want as a project primarily. The question soon will be, how do we actually get that? Going into, I think, what the liquidity should look like over time. So I got an example here of 2% depth, and always what we focus on is not like, is first of all, how much is there, but secondly, how consistent is that liquidity? I have an example here where there's 60K within 2% depth, quite nicely consistent. And then we have an example here where the liquidity just drops for multiple hours over time to zero or near zero. Well, that is bad quality liquidity. If an investor wanted to get in at that point, they would have a really hard time getting there. So therefore, it's really important that the quality of liquidity is consistent as much as possible. Like a straight line is the best, so it doesn't move and there's no gaps in liquidity. Same accounts for spread, right? Like, first of all, you want to have a spread within 40 basis points. You don't want it to be above 2%. And then it can definitely not be above 2% for multiple hours in a day. Here you have an example of a spread of 0.05%, meaning people can actually trade a lot without losing value or anything like that. So I also, like in the previous example here, this is just a snapshot. I just want to highlight that this is liquidity over time. The only way to measure quality liquidity is with consistency and regular snapshots. And that is what reporting should show and what we focus on as well. And when we do audits for projects or VCs or accelerator programs, this is what we look at. How consistent is the liquidity that is being put on the book by the market maker? So the question is, how does it actually get me an investor, right? Like we literally have OTC deals, offers thrown our way of projects that have no liquidity. So how do you actually attract these investors? Well, if you look at how much depth you need within 2%, you can attract, with each extra level of depth, you can attract a different type of, audience or a different type of investor. So if you have less than 1,000, maybe small retail can enter. You need around 7.5K of market making inventory in order to get that. If you move up, you get a serious retail trader, you get 2.5K of liquidity within 2%. You need funding of around 10 to 20K. If we move that up, let's say 2 steps, because this is stepwise, it should be quite simple. 7.5K to 15K in 2% depth will allow you to get, at least access to some mid-tier investors that are looking to invest like decent amount. If you look at and they can buy off the market, so to say. How much inventory you need? We utilize, let's say, 10 to 20% of the capital, so you need 75 to 100K in inventory, but it depends on the markets, right? And then we go to millions, right? Like at some point, it's like getting significantly more within 2%, and it becomes way more complicated to measure the quality liquidity. But you need 200K to a couple $1 million on the in inventory in order to get there, and that's going to be a bit tougher. But then you can get access to top tier investors or traders that are looking to buy millions of dollars in a single click. And that's where Bitcoin is. It's millions of dollars, easily tradable, no slippage. While here, projects that have less than $1,000, retail will have a hard time buying in, or serious KOLs or anything like that. And this is, again, how you get the investors in, making sure there's more liquidity on the book, Of course, paired with proper marketing and proper fundamentals, but this is on the liquidity side what you need to do. And the same accounts for exchange listings. We'll go into that in a bit. Like, how do you get on Gate? How do you get lower fees to list on Gate? Well, it heavily depends on the amount of liquidity you have and the statistics you show and the trust they have in that you will bring volume to the exchange. So the question is, how much liquidity do I need? Well, the very much minimum for any project, in my opinion, is 1.5K within 2% depth. Below that, like, you would really be seeing in how we look at it as like a very small project, less serious, or hasn't done a proper distribution of that liquidity. I think the biggest question is actually who you're looking to attract. Because if you're looking to attract retail, or if your project is you need to stake $2,000 and an investor needs to get on board, well, you also need to make sure there's at least $2,000 within a decent range. Or if you look at ETH, if you need to secure a network, right? Like, you don't do that with $1,000 trade. You do it with millions of dollars and really heavy guys coming in the market. So who you're looking to attract and how much people need to use it. And I think another important one is which chain are you on as well. Because if you're on ETH and people have a hard time buying $50 on your market, and they also pay gas fees normally to move that around of a couple dollars, well, that's a couple percent of the average purchase size they do. So of course, the more the better, but you need inventory to get that liquidity on the book, because like I said, 80% of the liquidity initially is going to be your market maker, unless you're a top 100 project right at launch, right? Then it's significantly different. So now we're actually getting into, I think, the more juicy part when we go into some agreements and the listing strategy and everything around that. Because we, over the past, I think, month, we've seen a couple examples with Wintermute, some deals they have done, and how can this happen? Why are we still seeing this? Why are we still seeing these pump and dumps? Why are we still seeing Mantra like dropping significantly? Well, although this might not be fully a market maker example, these things continue to happen, and we continue to see pump and dumps, retail getting screwed, projects getting screwed, and it's a bummer to see. And I think there's a couple main issues that make this happen. The biggest one, I would say, is actually a paired one. It's wrong incentive models paired with lack of education. And I think that's why we're here, to educate projects more on like what happens behind closed doors. And if you're a retail trader, or you're just not a project or an institution, I think this is super important information. Because if I were a retail trader and I need to invest in a project, I would personally want to know, like, what type of market making model do they have? When do unlocks happen? What launchpad did they use? What were the terms there? Because you want to know what the red flags are they actually got caught in. And after working in the space for at least 5 years as a market maker, you start to see a lot of cracks that are happening. The different type of incentive models that later on screw over projects without them knowing. And we've heard a lot of stories, and that's why I think it's important that we have these type of webinars and conversations. Second one is the lack of collaboration. We often see market makers just simply turning on bots and that's it. Well, if they don't charge too much, I think that might be fair. But I think one of the biggest one actually is the lack of insights and transparency the market maker gives to these projects. Well, if you need to manage a market, you have so much information, and I'm just not sure why they're not sharing that with the project. And how does the project even know what the market maker is doing if there's no dashboards or anything like that shows over time what is happening? And I'll touch upon that in a bit. I think it's not only the transparency around like what they're actually doing and the KPIs that matter. Keep in mind their job is to fill order books. But it's also the lack of transparency in terms of knowledge, right? The market makers understand the deals that they're getting into. There's not like a course you can buy on how do you hire a market maker. To not get caught on like the tricks that they play or the things that they're doing. Well, we've audited a lot of loan option model agreement, a lot of other agreements we've seen, or how people structure it. So we know how it's done. And I think it's important for projects, retail investors, and everyone to understand how does that work. So the question is, how do you pick a market maker? And well, for some people it might be depend. I'll recommend a market maker based on the commissions, but I think these are the things that actually matter. It is, in my opinion, collaboration, analytics and reporting, which is probably one of the biggest one, ethics, and then the model and the terms. If I look at importance, I think I would rate them as like this one, number 1, number 2, number 3, number 4. So let's start with collaboration. Actually, how do you assess that? Well, I think most of it is based on the sales call itself. Are they trying to sell you something, or they're just trying to help? At least the way we've structured is we track analytics in a dashboard to understand where they leave some opportunities off the table. And we actually consult them. We're like, hey, this is what you should do. Often it's like, hey, you should probably talk to your current market maker about this. Or, hey, let me review your tokenomics. I think that's a collaborative approach. You can feel out a little bit how that works. I think another big thing that at least we're doing, and not a lot of other, like what I think is really important, if possible, you should get a trial. Understand how they work, how they collaborate, what they're actually doing, because otherwise you're stuck with a 3 or 6 month agreement. Well, this is not possible for TGE and launches, to be fair. It's too much work involved in order to do a trial. But if you already have a product and you look at a switch, like a trial is a great way to start to fill out if you're going to make the right choice. Second one is analytics and reporting. I'll show you in a bit what analytics should look like. It's not about reporting static reports. It's all about how much depth have you put on the book, what is the quality of service you provide, consistency, what matters actually. Not a single report that shows how much volume the market maker has traded. Because to be fair, they can fake that anyways. To be fair, you can fake your own analytics as well, but that's the bit of trust that needs to be involved. And all the data, like a lot of the data that we have, because it's on the client's account, you can actually verify yourself if the data that we push to the database is actually the right data. I think there's an interesting one. Someone asked me the other day, like, how do you know if a market maker is ethical? And I thought about it, like the question you should just ask him is, can you pump my token? Like, and if he comes up with a plan on how to do it and everything, and like you can start to feel out like what is good and what is bad. And especially if you ask him like, can you pump and dump it? Like, and he just says like, yeah, sure, no worries. Like, a little bit what he's up to, right? I think part of ethics is also just understanding that there needs to be analytics so you can, and then showing the data to the client. Biggest one is the model. There's a place for every type of model, in my opinion. I just think depending on the stage you're at, one model makes more sense than the other one. And then most importantly, KPIs, especially when you go into a loan option model. How are the terms structured? I don't put in speed here. And a small note on that is that I don't think for many projects, speed is too important. Like, of course, your market making needs to be fast and like faster than the competition. But we've seen like if you, unless you're like a top 1,000 project or a top 500 project, like speed is really going to matter. So that's why we focus a lot for these big projects, a lot on speed. For small cap projects, like in a way that they shouldn't care about like how the market making is being done. If we have 1,000 people clicking buttons the whole day, or if we have the most crazy AI algorithm, in a way it shouldn't matter as long as we get the job done, which is putting liquidity on the book and of course not losing a crazy amount of capital on your market and actually make money for you as well. So quick sip. Definitely, if there's any questions popping up, put them in the comments. Like I said, again, I'm going to repeat this a couple more times. Even after the webinar, I'll answer them. So if you have them right now, put a screenshot in maybe of the slide that you have in front of you, and let us know the question you're having. This is also for us a really good way to figure out like, hey, what should we be talking about next? Because maybe in the next podcast, we'll touch upon your question and we'll answer them in the chat as well. And at the end, I might answer them for you. And don't forget to also shill a little bit your project or what you're doing. So everyone in the community or everyone in here right now is actually understanding what you're doing. Maybe you guys can collaborate. And we have a couple BDs in those chats as well to check out what you guys are doing. They will reply to you. So don't trust Verify, right? That's what we're all about in the crypto space. But apparently not really in market making. So what metrics do you need to assess performance of a market maker, or what do we look at, and how do you actually know your market maker is doing what they're supposed to be doing, right? Couple metrics you need. I say analysts you should demand. It's almost demanding it, especially on retainer models. Like, hey, well, you're on my exchange. It's my market. It's my accounts. I want to see that data because you have it. 100% of the market maker has that data available. They just don't make it public to you for some reason. And that's why market making stays a black box. You want to get balance information over time, trade information, and not a CSV with data. You want to see a simple to use dashboard over time, what is happening, any time frame. Trades, total trade sizes, how much do they buy and sell, what do they actually do? Volumes on the market to actually track your performance over time as well as a project. 2% depth, how much did they put on the book? How much was total on the book? How much was organic? So you can actually track the progress of your market. Spread, of course, how well do they manage that? And then any other KPIs that you've set with them. If your KPIs on, like, an example, we're working with this bigger project, and they don't care about 2% depth. They care about what is within 0.5% depth. Like, that's a KPI. Well, then we report those numbers to them because it's important. And this is what it looks like, or could look like. Balances per exchange stacked over time. This could be a 1 week period. This could be a 10-minute period. This could be a 3-month period. At least be able to see how your quote balance moves over time, plus your base balance at the same time. Well, then you can actually, if something happens on the market and you don't trust what happened and you want to do your own due diligence, you can actually go in here and see what's up. Then the other one is trades. Just see over time where trades happen. You can line this up with price to actually see what happened. This is all the total volumes in this period, and we can query this for any period. And clients have access to this. They can simply click a new button and see what happened in 10 minutes, or like I said again, over the past 3 months of time. One of the biggest ones and most important one is total liquidity within 2%. How much did they put on the order book on both the buy and the sell side? Because that's their job. That's their job, is filling up the order book so other people can trade. So you can actually see total liquidity. What did they put on the book is what we actually show. And then what is organically on the market? So what do other participants do here, and how do they trade? Well, we're not expecting projects to do their own market making and go in here and see what's up. Well, but at least they could if they don't trust what we do, and we guide them through this, right? Like we hop on weekly calls and be like, hey, this is what happened to your market. This is what we saw. This is the anomalies. These are the things that happened. Same for spread. Like, how do spreads move over time on a market specifically? You can see them per market, but these are the minimal things, and especially this one is really important. We've asked projects, or we've seen loan option models where they have no idea how much liquidity is on the book, or they had no idea how much funds the market maker even had. And this is a really interesting thing we could see from here. Well, this is from the 25th of November until the 24th of January. And we see 100K buy orders showing up on Bybit over a period of time. We see liquidity here on BitCat dropping significantly. When the Bybit hack happened, we saw on a lot of markets organic liquidity dropping significantly because other market makers are pooling their funds. Well, these are the things that, and then we can help them make better decisions, right? Which exchanges actually perform well? Was this a good investment? Which exchange have the most amount of volume, right? Like, maybe these exchanges are in a specific region, so you know where your audience might be. Did my marketing activities that I do actually result into something? So we can help them with this as well, with the data that we have. And you don't have to be an expert. It's easy to understand. But most of the time, we discuss it with you in a call and be like, hey, this is what happened. Um, so now the juicy part, which is really about exchange listings and market making models and how it can break your project possibly. Because we see this a lot. Actually, we have literally a loan option model in here which will break down for you. We don't have the name of the market maker, obviously, or the project, but literally have screenshot of the specific terms in there, so you fully understand how they work. And I think it's so for every project that is getting these things thrown at them, and they will, especially from this one specific market maker that is quite known. Like, you will get the same agreement, but you need to understand every single term before you can make a decision like that. And I hope that that's what we, trying to give some clarity around today. By the way, check out this article. Work with Johan on this, and we involved a couple other people that are actually talking about this, to create a bit more awareness. So check it out. It's an interesting article. We hope to follow up with this as well, and actually some practical tips, which we'll discuss today on how do you actually get into a proper loan option model agreement, and how do you hire, or how do you pick the right agreement in the first place. A lot of text, so take a screenshot. The pros and cons, or how the loan option model and retainer model are different from each other. So most simply, a retainer model is you get your own exchange account, fund it with tokens and USDT, give the API key to the market maker, and they'll start to provide liquidity. Loan option model, the market maker takes custody of the funds, they borrow it to you, they loan it to the market maker, and the market maker will provide the quote asset and then does the market making. There's no monthly fee associated. They take custody and they'll do the market making for you. As far as this sound, it sounds really good, because like, you don't have to do much. You don't have to come up with your own quote asset. So let me back it up. And especially on this topic, if you have different opinions, I would love for you to actually put them in the comment section. I would love to discuss them. Because I would love to find people that disagree with our stance on this loan option model, and how the terms could fuck over projects, especially early stage ones. So the inventory, custody is on a retainer model with the project itself. The market maker, in this case, in a loan option model, it takes a loan. How the retainer model market maker makes money is they pay a fixed monthly fee per month, anywhere between $1,500 to $4K, $5K per market per month. Well, how the market maker loan option model makes money is the token allocation and the specific strike prices, plus a trading P&L. So if there is a lot of volume on the market, and I say if, they can actually make a small percentage, every single day on the trading itself, because there's a lot of volume. So if there's not a lot of volume, and I'm talking about like multiple hundreds of thousands of dollars per day, like, this one is not a trading profit for them. So they have to make money in a different way. So you should keep in mind, the goal is to create a healthy market so other people can trade. And the control over the strategy and what is being done is in the hands of the project. In this case, they collaborate with the market maker. They can say, hey, we would love to see better quality liquidity on these and these levels, and do it this in this way. Well, the market maker, of course, could fire back a little bit and be like, I don't think that makes sense to do. Give a reasoning. Well, on a loan option model, you cannot just tell your market maker and be like, hey, we actually would love to handle the liquidity this in this way. They'll do whatever KPIs they have set or you defined, if you even have KPIs set with the market maker, and they'll do whatever is in their best benefit. And this goes into the last section, like, who are they working for? On a retainer model, the primary job is to make the client happy, and they do that with proper liquidity. On a loan option model, I would almost call you hire a hedge fund. So you hire someone that works for them and makes money by profiting from the trading, and only cares about their own. Of course, they care about the success of the token, right? Because if the price goes up, they make a lot of money as well. But they primarily just do whatever makes them the most amount of money. So the incentives, I would say, are a little bit, in my opinion, misaligned, although the alignment is also to make a lot of money and get the price up. But to be fair, it's not the job of the market maker to get the price up. It's the marketing and the fundamentals and the traction that it gets. And the market maker is just passively there in order to make sure other people can trade. I don't know what. Little shilling in between. So if we do a 2-week trial actually of free market making, and I'll put this in the end as well, and we'll put it in. But take a quick screenshot or scan this and fill in the form to quickly, we'll reach out to you and we'll do 2 weeks of free market making for the people who actually participated here. So I'll leave it on for 15 more seconds while I take a sip of water, and then I'll take it off. Cool. And we're back. So let's look at a real loan option model to actually back up a little bit what I was mentioning before here and how it works internally and how I feel like you might be betting against your project if you do a loan option model versus retainer. But also, to be fair, where a loan option model fits in. Because I do think there's a place for a loan option model, but not for everyone. And I think it doesn't apply for 80% of the projects. And I don't know if Justin is in here, but Justin, I'm waiting for some questions at the end. So do let us know, because I know you and I would love to have a conversation with you around it, because I think you're a little bit more pro loan option model than I am. So would love to have a chat about that. So the general structure is you borrow X amount of tokens. And in this agreement, they borrowed $180,000 worth of tokens. And at every single level, and I'll show it here, there are certain strike prices where they exercise, they can say, hey, we can buy back 20% of these tokens, which is $36,000 at 125% of the opening price. So this is 25% above where the price gets, token gets listed. So let's say the price doubles, right? Like you're here at 25% above you have the first strike price. The price doubles. They can pocket a 75% profit because they're allowed to buy back the tokens at 25% above the current listing price. Well, of course, the strike price increase. So you also have at 150. This is a 24-month agreement, right? So, and then you also have something like a TWAP. So, it's not particularly the opening price, but the first 14 days at which it's traded, the asset, that's what determines the strike price, so to say, and then put 150% above that. So again, if your price more than doubles, they have the right to buy it back for a specific price, and then they can sell it, pocketing a big profit. Well, that is not a big issue if they are that's the profit for them. That's not a big issue if they at the same time also provide a very healthy market and help your project grow. But I think that's where it often, fails a little bit, in my opinion. Because if you look at the KPIs, they're structured like this. Bid and ask spread, 35 basis points. That's so simple to maintain that we would create a tighter spread for $100 a month if you want us to. That's too simple. But what matters again is to create a healthy market, which means both sides liquidity, buy and the sell side, with enough, on the book so people can trade thousands of dollars, right? Well, you actually want to put it in KPIs, because otherwise, why would they do that? And you'll see that in here. If you read this last section already, it's very interesting what they say. So the 2% depth, what they say around this is we'll provide, it's organic support. That means one of two things. It means how much, it depends on the organic support, how much we'll provide, or, we don't do anything. It's just organically supported. Then they need to trade more than 7.5% of the volume on the market. Well, they can fake that. I think you can manipulate that. But again, the most important thing you should get out of an agreement is someone that provides two-sided liquidity, both buy and sell side, with enough on the book to support your market and create a healthy market. That's the benefit for the project. The cost for the project are these strike prices, and they can be very, very expensive. So, and then this is what they say: the service level agreement, the service provided. In section C, they say, using commercially reasonable efforts to add liquidity to the token on the selected exchanges. There's no commitment. There's no uptime in terms of how much that needs to be provided. At least, like, this is one agreement, but this is how a lot of the agreements are structured. We have seen stories where projects are actually, not even sure if the market maker still has tokens. There's no data provided on how much liquidity they provided. And this is a section that goes into reporting. What they report is traded volume and the market share percentage. But then there's not much around 2% debt provisioning, and especially not in a dashboard. So how do you know that they're actually doing something? And this is the biggest issue. If there's nothing wrong with the loan, I'll go into that. There's nothing wrong with a loan option model in essence. If there's a healthy risk reward for both the project and the market maker, I think this is a beautiful way to do it. As long as you get the service provided, because the market maker doesn't have to do shit here sometimes, because there's nothing in the agreement that keeps them accountable for being in the market. And if anything, they get a huge upside if the market does go up significantly, because if you do a 3x, they'll just dump it on you, and then they pocketed 180K for nothing. And so they get almost zero risk and get a huge amount of upside. And I think that is where the issue is. If it's a healthy balance between the two, I think this is a fair model. And I'll go into the projects that do get a healthy balance, because there, like I said, there is a place for loan option models here. So again, ask yourself, what is the value you get in return? Which should be the depth provisioning, healthy, and collaboration. How is this reported? How do you actually make sure that they do what they're supposed to be doing? We sometimes feel like the guys, like, we're doing other people's jobs sometimes, which is we'll keep an eye out for. We're working with this project, for example. I think there are top 400 3 loan option models, and we need to put our analytics on their markets to verify the other loan option model market makers are actually doing what they're supposed to be doing. And I find that super weird. I'm like, well, let them do it themselves. Why would we need to do that? Let them be transparent about it. How the incentives aligned, and then most importantly, how do they exit positions? I think there's terms you can change to make them not dump on you, but make them slowly exit with even vesting schedules that could apply to exiting those positions the moment they're exercised. So again, these strike prices look like this, where they can exit X percentages of the total supply, or of what you're getting. And in the previous example, it was a 4%. They got 4%, I guess, of the supply, so to say. And these are the strike prices, just to visualize. And these will form natural ceilings, because if price goes above it, the market maker will sell into it. So you'll have a hard time. And if you were ask yourself, how much does this loan option model cost me? If my project goes 2x, how much does it cost me if a project goes 3x or 4x? Because that's not unusual in the crypto space. And then if you compare that to a retainer model, well, maybe that's the better way to go. Well, but you also got to supply the funds, and that's the thing. So a quick reminder is, what is the core responsibility for market maker? It is to create a healthy market. Are they going to do that? And can you put it in agreement? What are you betting on? You're betting on yourself, or against yourself? And then the other question is, like, who are you hiring? You're hiring a hedge fund, which is, Wintermute said it as well themselves, and I think it's fair that they say it openly, because To be fair, I think it's not only the it's not particularly the market maker's fault that they offer this. It's sometimes the projects that should also just get educated, like in some form of way. And I think that's tough because there's not a lot of information around it. So how do you get educated? But Wintermute said basically, like, we're not a charity. We're here to make money. So they'll do whatever they want to do or can do within the terms they have and their ethical boundaries in order to make a profit. And if you haven't structured the terms correctly, like you have nothing to stand on in that case. So you got to be cautious with whatever you sign up with. One thing I found at some point, I was like, well, the quality of liquidity comes from the market maker's incentives that you put in place. So for a loan option model, how do you incentivize them, like, or the KPIs that are in place? It is not particularly that significantly better algorithms, do a better job. It's one example of this is that we're working with that project and we audited it, and like the loan option model market makers will literally they can improve the quality of liquidity, but why would they? Because by doing so they make less profit. So they can do it because they're fast enough, but like they will not do it unless there's an incentive to do so. So you got to structure those things very well, so they will actually, you get a better market and better liquidity. It's kind of like a game you're playing. You got to put KPIs in place. If there's enough competition, they will increase the quality of liquidity because they want to get more volume. So what do you actually negotiate in a loan option model? This is how you should look at it. So a couple things you can do, and I think the first one is probably one of the most important ones. When you're negotiating a loan option model, think about how much are we giving them in terms of dollars or the percentage of the supply. It is normal to give them anywhere between 1 to 3% or 1 to 4%. But how much is that in dollars? And to be fair, they don't need that money. Like in the example, the market maker doesn't need $180,000 of the token in order to market make. They're not going to use everything in this case. So ideally get as low as possible so you don't risk as much. Well, this might change the whole negotiation phase. KPIs, spread, and depth. Especially depth, 2% depth, or even half or 1. You got to negotiate it down. Put it in a KPI with uptime on those KPIs. Not a general like statement of like if it's economically viable. No, you got to put something in place that backs yourself up. Otherwise, they can just be like, well, market didn't look good. We didn't do anything. Strike prices as high as possible. Of course, the market maker also needs to make money somehow. And that's what I mean. If they can make money off the trading fees, because there's a lot of volume, because there's millions of dollars flowing through your market and they make tiny little profits, well, they don't need to make money off these strike prices. And you can negotiate really good terms, but you need millions of dollars of volume before you can get good terms. And it's the same with getting VC funding in, right? Like the better your fundamentals, the more volume, well, the better terms you're going to get. And it's the same here with loan option model agreements. You just got to have a strong project. And you might not be strong enough at launch, but later on you will in order to get good terms. So duration, maybe the longer might be more risky. What I'm saying that is about that in 2 years' time, your price might be 9x rather than 3x in a year. So there's also a risk involved in that. And I think reporting, well, you need minimally over time a dashboard or something that shows what is actually happening and how do they perform in terms of those KPIs. And if you have a loan option model, I'm happy to give you some, analytic for some time and then check it out and do an audit to see what's actually happening. But ideally, the market maker does this for you. And this is another important one because it's in the money at TGE or in the money at launch. What I mean with that is like sometimes these deals are structured, especially for smaller projects, where X%, where 30% is already in the money, meaning they can just offload the tokens to get the dollars, and then they'll put dollars on the book. So they'll first dump your token because what they can do is they say, let's say you launch at $1 and 40% is in the money at TGE. Well, they can just offload 40% at $1 without any risk, dump the price in that sense, and they have the right to buy it back for $1. Well, if the price continues to tank, they just buy it back significantly lower and make money. They can make, like with these models, they can make money on the upside and downside, because if they dump the token first and then it continues to dump and they buy back 50% lower, they still bought lower and sold way higher. This one is a little bit more complicated to understand, but you don't want, especially if the strike price are higher, you don't want any of the funds unlocking right at TGE at the current price. That means they can just dump it straight away. I'll definitely say take a screenshot of this, and if you chat with someone on a loan option model, go through these and be like, hey, this is what I've been told in a webinar. I need to have these things, and ask them, how are you going to make sure that you have enough depth on the book? And they might fumble a little bit. Like, I would love to get, like, pretend to be a project and talk to one of these loan option model market makers and see what they say about it, because I have my doubts in a way. Again, it's not the model itself, it is the terms that are an issue, in my opinion. And I think uninformed projects and an over-informed market maker that can, sell pretty well with a good reputation. And there are some heavy names in the space that use this model that know they can use their name because every project wants to get to work with those guys. And there's not a lot of volume at TGE, and they give them really bad terms. The project doesn't understand, and then 6 months later they come to us and we're like, well, we don't know what happened. We gave the market maker a lot of tokens, and I don't think he has them anymore, and my token price is down 80%, and then we'll have to try and fix it. And again, this is not an issue for small projects only, but even for big ones, like, it's less of an issue. An example on that is like this. This is what we looked at. Well, they have a clear KPI on 2% depth. So the market maker puts all the liquidity deep in the book, but they have no KPI on what is within 0.5% depth, which is better. Like, they're so big that doesn't matter if you have 2% depth, but what is within 0.5%. And you see that maybe like 1/3, 1/30th, or 1/20th is actually within 0.5%. Simply because there were no KPIs around that, the market maker has no incentive to do that. Another story we have heard is that at the end of an agreement and they need to renegotiate it, they were artificially keeping price down to get a better entry at the renegotiation phase, and then they could let the price rise up again. And basically the strike prices were lower and they could pocket a lot. And that's what I mean. The incentives are not aligned because of this. Well, retainer models are also not the best. So sometimes I'm like, hey, what do you pick? Because here are also some tricky things that can play out. And I got some stories here as well. So the general structure is as follow: monthly fee anywhere between 1.5 to 5K per pair per month. Liquidation fee anywhere between 1 and 50. I'll explain that in a bit. And there's profit sharing fee as well, 10 to 50%, depending on the market maker. Question I always have is like, how do you calculate profit? Because some market makers see profit as the amount of USDT you have in the account. Well, that to me is just how much can you liquidate. That's no profit, so to say. Profit should be measured as like, how often can you buy low and sell high, right? If you do that a lot, you make actual money. Well, a lot of market makers, they get incentivized by how much they can liquidate, which is in a way fair. They call it treasury building. It's not bad per se, but think for yourself, what is profit? Liquidations or buy low, sell high continuously? That's why I say watch out for retainer models, because this is sometimes what happens. 3 or 4 scenarios and the profit sharing fee or liquidation fee that is associated. They say 5K monthly fee, 1.5%, profit share. So any treasury bill that's being done, 1.5% goes to the market maker. I think it's pretty standard. You can do a 3K per month monthly fee in a 90-10 split, which means out of all the treasury that's being built, the amount of USDT you gain on the account, 10% goes to the market maker, 90% goes to the project. I think this is still acceptable within the 90-10 split. Within that is fine, in my opinion, because you're not over aligning incentives. Here you go into a little bit more like predatorial territory, in my opinion. You have a 1K monthly fee and a 70-30 split at launch, and then the outcome, in my opinion, is flat. But there is an incentive for the market maker to really start dumping, but it's not crazy high. I still think this is too much, in my opinion. I would love to see within 90-10 splits. Especially because if you think about it, the funnel again, and that's where we go back, it's not the market maker's role to get volume on the book. It's marketing that, and then fundamentals, and then the market maker's just passively waiting there. So the hard work in theory is done by the marketing and the fundamentals, and the market maker is just the end product of that. Unless the market maker has been involved in all three stages, I think it's fair to focus on this. And this is the worst one we've heard. Free market making, 50-50 profit share. This market maker dumped, it was not the biggest project, but they dumped 60K in 2 days, breaking crucial levels and making, I think they make 30K of that themselves. Well, you give them an incentive to dump, and they have the project has said like, hey, let us know, like, I don't want you to oversell. I want you to keep a healthy market as much as possible, and of course find like a nice balance between it. Well, if you do that, if you want that, a nice healthy balance between a price increase or a healthy market, and also liquidating some, well, these two seems to make more sense. Well, the market makes incentive was to simply dump the token, especially at launch, making a lot of money, and not thinking about like the market health. Well, that is the primary goal of the market maker. You got to incentivize them. So keep that in mind with retainer models as well, that they can be structured where you misalign incentives, or I call it over aligning, because you want them to build treasury, but you don't want to give them the reason to dump. So how do you pick the model actually? I think these are the 3 stages you go through when it comes to picking a retainer model or a loan option model. In my opinion, small projects, you don't have enough volume to negotiate good terms. Retainer model, it is. You're not going to get to good terms unless you really have a lot of traction, and there's going to be millions of dollars of volume at launch, to be fair. SUI is an example, like they'll get really good terms. Most projects, not so much. Focus on getting quality liquidity on the book so you can build volume up over time, become a bigger project where you can start negotiating good terms. If you go above 450K daily volume organically, I think that's roughly the threshold where I would say, hey, then it might make sense. You go into a hybrid model. Hybrid meaning you have a loan option model market maker because you can get decent terms, but also still a retainer model in some form of mix to keep the nice balanced amount of liquidity and keep the other market maker in check as well. You still gain all the benefits from working with a partner closely and getting maybe additional liquidity on the book. You might think 450 is not a lot of volume, and most projects reach that, but I bet you that most projects don't reach this quite easily. That takes a lot of time because a lot of volume is not real on the exchanges, especially sexes. But this is again the threshold, and it's actually a wider range than hardly 450, because again, you also got to keep in mind like, hey, what does your marketing look like? Because market makers will look at that and be like, hey, how much actual engagement do you have and hype around it? When you get to millions of dollars of volume, you work with loan option models alone, and that's fine. You get good terms. Strike price makes sense. Sometimes these strike price are not even exercised, like just simply because it doesn't hit it. The market maker still provides good KPIs and good depth on the book, and this is again where it starts to make sense to have loan option models when you have enough volume so you can get good terms. So there is a place for it. Very quickly, can you be your own market maker? For sure. Wouldn't recommend it for a lot of projects. But if you really want to cut down costs, this is the strategy that I would do. I would say get a market maker on your main markets. You cannot be a big project. Get a market maker on your main markets to have good, stable liquidity there. And on your tier 3 exchanges, you might use a tool like Hummingbot in order to get some liquidity on the book and cut your market making cost. Only on low volume markets. Well, the thing is, you don't have a support team. You might need to hire traders. Like, market making is not easy. There's a lot of things that can happen on the market you need to be aware of. The infrastructure needs to be managed. So market makers can be efficient because they have a whole trading team around it that works 24/7 in infrastructure. If you do it yourself, you probably don't have it, or it takes a lot of time to build up. So just wanted to share, it's possible, but I would not recommend it on your main markets, only on your smallest markets, and if you're not too big. I think the fun part is picking the listings. I think the biggest tip is a solid listing strategy is not about quantity, it's about quality. Quality of listings plus quality of liquidity and how you maintain them on an exchange. Cool. I've kind of rated the exchanges in terms of, in my opinion, prestigious or authority, and I'll have a different rating later on. But how I'm looking at it, so you have fixed prices for some exchange. You have on like the tier 1, like Binance, Bybit, OKX, KuCoin, Gate, BitCat, Huobi might fill in here, and then you have MEXC. From this onwards, like this line here, you have below, you have fixed prices for listings. Anything above that, you have variable pricing, which depends on the traction you have, the volume, and they start to assess your project, and rightfully so, because they want to keep the quality of listings high enough. So to me, MEXC has always been the entry point into the tier 2 listings. They bumped up their prices to 120K a couple months ago, and now it's back to 60K, 30K USDT, 30K tokens. And I think that's a great stepping stone for most projects. I have some other concerns, though, about MEXC. But although there are some concerns that I have, I still think it's, in terms of price quality, one of the better exchanges out there. I actually started, rating them and how accessible is it to get on those exchanges, the cost roughly, and I bet there's some listing managers out there that say like, hey, this is completely wrong. Well, it's a very wide range I often give, just to give some perspective. And then the organic demand that we see on these exchanges. And the reason you get listed, right, is because you want more volume on the exchange, on the market. You want to tap into a new user base, get more traction, everything around that. So this is the most important metric to follow. And as a market maker, we know exactly, how much organic demand an exchange is giving, because we are, these projects that we have are listed on 5 of them. We know exactly which markets have more volume than the other ones. And of course, it might be project specific, but if you do this for 30, 40, 50 projects, well, you start to see which exchanges actually bring volume and which ones don't. So I rated them. Of course, Binance highest, Bybit, OKX are really good, and KuCoin and BitCat and Gate roughly same. But I would say MEXC, if you look at it, is actually quite good. Sometimes for us, the projects that we market make for, it surpasses the organic volume of KuCoin and Gate and BitCat. Well, they might have a higher reputation, and they definitely have a higher listing fee, and they don't have a fixed price, and it's very hard to get listed there. But it's crazy to see how much volume we sometimes see, or how close it is. And that's why I say price quality ratio is really good. Every project can basically get listed there as well. So we they have most of our clients are on MEXC, and then they add a higher tier exchange, or maybe a lower tier. But we often see this as the stepping stone into exchanges. Definitely say take a screenshot of this, and if you have updated numbers or you see something differently, I would also say put it in the chat here. If you know your listing prices, or you've had a better listing fee than what you see here, definitely put it in the chat. Other projects might learn from it, and we would love to get to know how you get them as well. In a bit, we'll actually go into how do you pay less for listings on exchange like Gate, KuCoin, OKX, and Bybit. So it's actually 4 things that need to be done, or that it's 4 metrics or 4 points that exchanges look at when deciding whether you get listed or not, and a listing fee you have to pay. So number 1, it's the liquidity statistics. They look at CoinGecko, they look at your volumes, they look at the 2% depth and the spread to see like, hey, is this a solid project or not? Well, for volumes, they might understand it's fake. So they'll go to DEX to actually see most of the DEX volume is real. How much volume did they really have? I think another really important one is how much hype does the project have around it, right? More hype means they expect more real volume, and exchanges would love to list projects that have a lot of volume, aka Trump, right? Like when it got listed, like it's not that Trump had to like call up MEXC and be like, hey, can you get us listed? MEXC just listed them very quickly. They hired a market maker real quick to put liquidity on the book, and then we're good to go. So there's no listing fee actually. And the last one is really interesting, and you can use it to your benefit, is exchanges want to know how much volume are you going to bring to my exchange if I list you? Because I make money off that. And if I make a lot of money on the fees that I'm collecting, I don't need to make money off your listing fee. Secondly is if I list you and there's more people going to sign up to my exchange, I would love to list you because I get new users on board that sign up. And this is often what I think Bybit really, really looks at is if you're not listed yet and you don't want to do a TGE, they would love to be your exclusive partner, and some exchanges will exclusive listing partner, meaning you have enough hype so they would like to list you, and you're going to be exclusively on Bybit, or you're going to be one of the few, so they get they can get new users on board. They sometimes put in a clause as well where you need to have a sign-up link and actually get users on that exchange with that sign-up link so they can track how many users you bring in. There's often deposits around it as well, where if you haven't brought in enough users through the link, you don't get your security deposit back. So that's one thing to keep in mind. But this is how to evaluate. It's not only liquidity. Again, it's real volume, the expected real volume, which is also the marketing. Or if you have a really good product, your fundamentals are so good, like you really solve a dying issue in the space, then they'll happy to list you as well for free. Or not for free, for at least a lower fee. So keep that in mind. A couple practical listing tips that we have found, just that I wanted to share that I think are just really important. It is token payments are no free listing. These tokens will be sold on the market. They're called marketing budgets. They're going to users. The exchange sells them themselves. It's not list, and who has to buy that up? Well, it's either you with the market maker that buys them up, or it's going to be the other user needs to do it if you generate enough buying activity. So if you pay 30K for MEXC, 30K in tokens, just assume that these tokens will be sold like very quickly. We see on other exchanges that the moment it gets listed, there's so much selling pressure coming on because they paid so much in tokens, and we'll run out of USDT very quickly, and there's nothing we can do about it because there's too much selling pressure on the book coming from the payment for listing fee in tokens. And this is very important when you start to think like, I need to go on as many exchanges as possible. Maintaining a listing costs you money. What I mean with that is like, you got to pay a market maker, first of all. That's going to cost you a couple thousand per month. Is that worth it? If you're going to get like hundreds of millions of thousands of dollars on trading volume, of course you're going to get a market maker there. But keep in mind, like, is it worth my monthly increase in cost to get listed there? Well, it depends on the deal you strike. Like sometimes there's unlimited market making deals, like unlimited markets. Well, then it doesn't cost you anything. But the second thing is important. You got to lock up capital. A listing is only worth it if you actually put liquidity on the book there. Because what is a listing worth? You pay like 100K to get listed and you don't put liquidity there, no one can trade. So what is the value? So both need to be in place. It's quality exchanges plus quality liquidity that's going to make it worth your listing. Lastly, and this is, I think, a big one when it comes to picking DEXs or SEXs. I think we're in crypto, so let's use a DEX at least. Like we're all about decentralization. I find it interesting how projects don't go for a DEX and only SEXs. Because if you think about it, like people that really want to use the token, they go on a DEX because that's where they can spend it or use it right away for the specific use case. There's utility volume. And then on SEXs, you have speculative volume significantly more. So definitely go on a DEX and also pick a SEX. How many? I'll explain it in a bit. And I want to thanks Tony actually for the term utility volume, because I think it's really good. Utility volume versus speculative volume, and the ratio between is interesting because I think there's a lot of speculative volume in the space. Probably 70% of it is speculative, and maybe 30% is really the people that needed the token to use it, that buy it. So what would my ideal listing strategy look like? Well, this is the most simple one you can use. But it depends on the size of the project, because if you have millions of dollars to spend, I would do something completely different. So this is for, I think, the average project out there. Go on a DEX for real adoption. That's just a no-brainer to me. Pick 2 tier 2 SEXs. And then if we go to the list that I have here, this is what I would probably do. I will go for at least MEXC, and then you can pick one below or one above. Ideally, you pick one above, to be fair, because these are better exchanges, but it depends on the funding you have available. I wouldn't spend like 1/3 of your capital on a listing there. I would wait until you have enough volume, or you really have a good product, or you have more funding in, so to say. An exchange listing is not going to save your project suddenly, so don't overrush it. If it's only MEXC in a DEX, that's also fine. But be mindful about it, how much you spend. You don't need to go on 6. You don't need to go on 3. 2 is fine. Even 1 is fine, but pick a good one. And again, supplied with enough liquidity. Like, there's no use of getting listed if there's no liquidity on the book. Well, we're at the end of it. That's an hour and 23 minutes exactly. Just want to make one more note on, who is on the call and what we can do together, ideally, right? Like, I hope I can get a little bit of credit for shilling a little bit. So if you're a listing manager, would love to have you on our partner program with exclusive commission on OTC and market making deals. If you're a feisty or institution, we help with large scale liquidations with minimal impact on tokens to make sure everyone wins down the line. We've done full portfolio liquidity audits of projects, and we've done master classes there, like the ones that you're at right now. Would love to do one for one of your projects so we get more awareness and we open up the black box of market making. I'll end with projects, but for exchanges, growth partner program, which means that we help you grow, get projects listed on your exchange, but there needs to be really good terms. We sometimes do free market making for those projects, but there need to be really good listing terms. Happy to discuss that. Accelerators, masterclass is where we teach projects more about market making, how to pick the right one, like today. And we do project mentorship as well, with people from our team actually joining the mentorship and getting people, teaching the projects the right fundamentals and how to build projects that go beyond market making, also into tokenomics, marketing, fundamentals, etc. For project, we have a whole list. Again, liquidity audits, we'll audit it for free, send you a 2-minute video, we'll give you access to the dashboards, just so you know what your markets look like. Feel free to request that, just send us a ping. 2-week trials, again, there'll be something, next slide. We're working with BitMEX free perpetual listings. Well, you got to at least be on 3 tier 3 exchanges. We do flexible OTC investments, which means you can turn it on and off on a daily basis rather than suddenly, 200-300K getting dumped on your market. So it's really a flexible win-win, sustainable OTC investments. And then things like tokenomics review. If you're getting listed, happy to take a look at it and give you our 2 cents on it. And as I mean, we're just trying to help out. send it over. Happy to take a look at it without anything in return. And of course, we understand that the more value we provide to you, the more you trust us, and ideally you become our clients, you become a partner. Again, I've said many times, any questions, put them in the commenting section, but definitely put it in our LinkedIn inbox. That could be to me, but ideally the company one. Send the question so we can use that for a next one, a next webinar or next masterclass. If you want to collaborate, if you want to partner, or if you need market making or anything, like definitely reach out to operations@enflux.io. We'll use that inbox to see what's up and get in touch with you. I would say it was a pleasure for sure. Here are our handles, a little bit more shilling, and then we're done. Follow me on X. I'm getting more active there. Most of you know me from LinkedIn, but I'm getting more active on X. Follow the company account. We do YouTube shorts as well. Getting started. But we'll be talking more about these snippets and the things that we do here and how market making works, just to get the black box, open it up. So follow us there, Enflux.io, and then of course LinkedIn. See you at our next webinar. I'm gonna go to the question section, especially the disagreeing one. So Julius and Z, send it to me on Slack and I'll answer them. I'll keep this screen open in case you want to sign up. While I right now go to the Slack part and some questions. Z or Julius, would you mind sending me a couple that came in? Yes, please. Yeah. Let me go to the commenting myself. Oh, I was there already. Not bad. 152 signups. Cool. Interesting. There's a lot of conversation. Let me see. So here I see. So market making are able to make some money for projects. So two things. Yes, like that should be. It's either of liquidations, but that's really how you do your marketing. And we're of course the one down the line that execute it. Secondly, if you have enough volume, there's a lot of arbitrage opportunities. We can trade delta neutral to make tiny little profits of the trading volume to actually make some profits. And that can then be returned back to the project or can be somewhat split. And I think that's fair. So that's how we make money for a project. But the most important thing to understand is when it comes to liquidations, it got to be a lot of marketing. And from marketing, people go down the funnel and then we can actually liquidate tokens. When it comes to actually trading profit, which means we buy low and sell high continuously, or arbitrage, that's where you need a lot of volume so these things can actually happen. And we might take tiny little profits if we're fast enough of that, which down the line leads up to a lot of profit. The thing that we shouldn't do, and this is, I think, where some projects do make money or market makers, is starting to move markets. In my opinion, market makers should be passive. What I mean with passive is passively waiting on the book for other people to come in. So that means that if we start move markets, which is not our job, in my opinion, well, I don't think that you could touch like unethical boundaries. So market makers should be passive, and they can make money of spreads and really fast execution. But I don't think they should make money of actually moving markets and going, buying low and selling significantly higher. But that is possible. Some market makers do that. But I think you got to have very strict ethical boundaries and guidelines within the company on what can and cannot be done, if that's the case. Favorite market makers? I'll give you one that I think is great. I love how they do things and what they stand for, and I think we align with their values, and that's Flowdesk. They're about transparency, having dashboards as well. I think they're great in what they do. I've never spoken to them. I would love to have a chat. So if anyone is in there, I would love to chat. But I would say they do a good job on especially the bigger projects, the exchanges and stuff. As far as we've never heard anything bad from them, and I think they align with the same values that we have. So, and I think that's important. Cool. I think we're good to go. Julius, is there or Z any other important ones that we should cover for now? I have 81 comments in here. That cannot be right that this is it. There we go. Okay. We have significantly more. Let me pick a couple. Sander, goedemiddag. OM Mantra. Let me explain it with the information that I know, because it's more like I made a post about it on like how a loan option model could have actually, caused a dump like this. I'm not saying that that's the case. I know the market maker that we're working with, they have a different opinion on it. But what could have happened, right, is a year ago, the price was significantly lower. Priced it at 10x, which means that if the market maker bought like, let's say $1 million they borrowed and prices at 10x, at some point the loan option model executes, $10 million will come on the book because they can execute and liquidate that. Well, it would be very dumb of them to just click the sell button and dump the market, which I don't think. But that's how it would have happened. So if your token price goes up 30x or 20x, right? Like there's like a multiplier that goes on the book at that point, because they have probably the right to buy it back maybe 100% above where the price started. That's where their first or second strike prices are probably. So they probably, if it's $1 and the price goes to $10, that's a 10x. They borrowed $1 million, probably more. That means that in the higher price, it's $10 million that is then executed and they'll dump it on the market. And that's how price could go down. I think their market was liquid enough to sustain $10 million. And I also don't know what the percentage of supply is that, they actually receive from them. So it's more hypothetically. I don't know the agreements that are in place. But what I would love, I think it's so essential for retail to understand the agreements that projects have. And you know how you have CoinRank where the unlocks are actually being mentioned, and people see that and proactively trade on it if they need to, and there's transparency. I think the same should be with these agreements on loan option models. Doesn't mean they need to tell which market maker they're working with, but I think at least the terms on them should be publicly available. Like I'm happy to, and I think that's where DAOs come in, right? Like where they need to be publicly approved by a community, the terms and everything. Like I'm happy to put my terms on the table if the project is okay with it, because there's nothing fancy. It's like a couple thousand per month per market plus 1.5 in liquidation fee, whatever we agree upon. But when it comes to loan option models, they can have a serious effect on the risk for investors and supply and demand. These things should be publicly available, in my opinion, because it's about so much money, so to say. Hope that explains it. I wish I had a definite answer and I knew what was going on in the agreement that was in place. It's more hypothetically and what happened. Cool. I see some. Let me go back. I need to load a couple more comments here. Yes. Correct. Happy to be here. It was great. True, but it's also the project to at least limit the operation to get screwed by eliminating the biggest and obvious threat out of the game. That's what Eugene said. I think that's a fair point. Why I think that's a fair point is because as a project, you have an obligation to the community to have a healthy tokenomics and supply and demand. So you cannot always blame the market maker. The market maker is just playing the game. They put the terms on there. You should be able to do your due diligence, ask them a bunch of questions, talk to other market makers to really figure out what is happening before you sign an agreement. That's why I think you cannot like what happened with Wintermute. You cannot blame Wintermute. They're just playing the game. Like the project signed these deals. So I would, of course, if they would dump it, I don't think that's ethical. You can say something about that, but the way they structure the deals, there's someone signing it, so you're both responsible, and probably the one who signs it is more responsible, and they have an obligation to the community. I think that's a really important one. So good information. Just wondering why market making is required. If project got good utility, my current state of mind is project who run by market makers, simply stay away from it. Well, that's a very interesting one to say, right? Because what we talked about is on the DEX, the liquidity is managed in a liquidity pool. You just put it in. It's called automated market making models. Like you don't need a market maker. That's awesome. I think it's great. Everyone can launch a token. When it comes to sexes, like if you have good utility, like who's going to fill up the order books? Like there's not enough utility volume or speculative volume to put limit orders on the book here. And that's a big issue. So and then the thing is, if those orders are on the book and they get taken, like who replaces them? Like, so there's liquidity, consistent liquidity at all times. You need someone with algorithms to do that. And happy if you're the project itself and can do it, but most of the time they don't have the expertise in house, or they want to focus on something else. So I would I wish that like we might not be needed. Although that means that we don't have a business. I mean, we got other verticals, but we're putting ourselves out of the game. But it's almost like there's no other way. And it's not that market makers are only in crypto. Like I bet Apple hires market makers somehow, like or with some other structures. In Forex, they're market makers. Well, they trade for profit basically. Well, if you're big enough, if you're Bitcoin, like you don't hire a market maker, the exchange will make sure there's actually liquidity, and there's other incentives to put liquidity on the book. But I would almost like, first of all, you're not getting listed without a market maker, because the exchange needs to have secured that there will be liquidity on the book. Secondly, like good luck getting that liquidity on the book without a market maker that has the algorithms. That's the thing. There's not enough for most projects there at launch. There's not enough actual trading happening, and especially a couple of weeks down the line where the hype is kind of like been cooled off, to make sure there's liquidity so other people can trade. So I wish it was possible, but I don't think it's really an option. And again, it's not that like market making is only happening on the crypto space. It happens in Forex, in stocks. It's there's actually a post that I did about it. Like market makers have been around for a long time. They're basically people that were at the stock exchange even, or on a market, just simply always being there as someone you can buy from and sell to. They make an asset liquid by always making sure there's a counterparty to trade with. Well, you might not get the best price, but an asset gets liquid because you can immediately execute it. And I think that's very crucial, to be fair. What about volumes for a new project that just launched and is expected to list on them? I feel like that goes into exchange listings. What about volume for new projects? My answer, as far as I understand the question, I'm giving it a like, would be that it is not the exchange. Like an exchange is one. They just have a bunch of users, and as long as you market it to those users and they're interested in your token and there's marketing happening, like they will come on and buy. We don't do it as market makers. Like we don't drive demand. We make sure that if there's demand, they can actually execute. See, there's a funnel, right? Let's say you get 1,000 people in that want to buy. Some people want to buy a lot. Some people want to buy a little. Like what is the percentage of that I can actually convert because there's solid liquidity at any given point? And you want to make sure that like liquidity doesn't drop, because if an investor wanted to get in at that single point, like they wanna be able to do so. They don't want to have to wait 30 minutes or use a market maker to get in and out of positions because it's not liquid enough. They want to be able to execute fast. The faster they can execute with large transaction sizes, the more adoption you'll get. It's about ease of execution. How buyable or how sellable is your asset in large transactions? That's how you can get that adoption if your marketing fundamentals are great. Yes, I'm aware about this, but every system is used wrong way too. There are market makers who don't care about projects and community. Example OM. Well, again, it's the incentives. Like, do they need to care about the community? In a way, like, again, Wintermute, they're not a charity, they're a hedge fund, or like they're an algorithmic trading firm that just want to profit. And if you have signed a deal where they can screw you and the community over, they might do it. Of course, if the reputation is getting worse because of that, they might not do it. But you got to make sure you have the right deal in place and the right incentive structures. Let me see if there's some more questions. If there's some more questions, definitely put them in the comments. GM, cool. Let me see if there's some new ones. Otherwise, I think it's about to end. If you have any questions left, like, let me go to the previous screen. Definitely put them, or especially if you disagree, definitely look us up or send them in our inbox. Cool. I think that's it. We got one from Zhao. You mentioned a good enough mix for a project with limited funds is to do TGE, 1SEX, MEXC, and 1DEX. From what I heard multiple times is that AMM on DEX are quite fast and eating up liquidity fast without control of a market maker. Aren't there more risk on a SEX plus DEX to start with than two SEXs, example MEXC and BingX? I think that's a great question. Well, it's a preference as well. I like DEXs because of the decentralization that we have within crypto and Web3, and I don't think we should go around it. And if you look at how does a token get adopted, if you buy it on a SEX, then have to move it to your MetaMask to actually use it, that adds friction, and it doesn't make sense in my opinion. Well, the biggest downside of DEXs is that if you have $100,000 available for liquidity, well, the capital efficiency and how much liquidity you actually get on the book in an AMM model on Uniswap is significantly lower, the capital efficiency, than if you go on a centralized exchange. If you, an example, if you get 100K USDT on a liquidity pool, you might get 2% of that, within 2%, 2K. If you give us 100K, well, we can put 10K on the book there, within 2%, because we can be more efficient in like moving the liquidity up and down based on what the price is doing. Well, of course, you have Uniswap V3. Well, that's a lot of management, and we support V3 liquidity management. But with every time you almost, move the liquidity around, it's almost like you move and cancel and replace limit orders on the book in Uniswap V3. Well, you got to pay gas fees. So it's going to be very tedious to do so. So I think you have a good point where it's less capital efficient. You uses up a lot, but if you want to stay within the crypto ethos, I think it's very essential to have a DEX, in my opinion. Doesn't mean you need to, but it's just a preference, especially when you want to get adoption. If it's purely about speculation, you can just pick two SEXs. And I think MEXC plus BingX is actually a good strategy rather than MEXC plus Gate, because Gate is very expensive. Hope that answers it. Good question. I think, let me try one more time to refresh to see if there's any other more questions. Cool. Liking some. Let me put them on most relevant. most recent comment. Oh, there's actually a good one again. Which market maker do you think doing most manipulations? I don't know. I feel like I shouldn't comment on this, but there's one specifically that I'm just not that happy with to be in the space, and they're one of the biggest. They do a lot of loan option models with these smaller projects, and we see them, and their name comes up over and over again the moment they, we see project getting screwed. Yeah, I don't want to call out other market makers. You can message me privately. I'm happy to talk about it in the chat, but I don't think it's fair to do that. But interesting question. Mete says, hey Jelle, thanks for the great presentation. Aligning with the actual situation, I focus more on market making project relationship. I'd like to hear a few words on market making sex relationships, common interest, nice to haves, no-goes, attractiveness, and sex for market makers, and vice versa. It's focused a lot on market making project relationship. I think that's great. Market making sex relationship. Well, I think they need to have a good relationship for two things. If something happens with the sex, they need to move fast with their infrastructure and algorithms. They need to be able to go into it, text someone and be like, hey, what's up? Ideally, like a tech person that can help you very quickly to get the issue resolved. That's one thing. And but that's not the biggest one. I think when it comes to relationships in terms of getting projects listed, I think that's a really important one. You want to have an in-house way, like a way to get into these exchanges basically, and bypass the waiting list or the general kind of like process of deciding whether a project gets listed or not. You want to be able to get feedback on like why a project doesn't get listed. So I think that's where listing managers come in because they have it, but I think also that's where market makers should come in. And then I think what is really important is understanding as a market maker what needs to be done on the liquidity side to get listed. Where does the depth need to go? How much volume do you need? Because one thing is crucial as well is if you go to KuCoin and you apply there, you don't get unlimited shots. You cannot send them a request every month to get listed. Like they'll put you, like if they decline you, you're declined for at least half a year before they re-look at it. If you get delisted, sometimes they don't even, like BitCat doesn't even let you get listed again. There's like a hard requirement. Like you've been listed before, you're not going to get back on. Like unless you pay a lot, they'll probably reconsider, right? So I think it's important for two reasons to have a good exchange relationship. Is one, to get the tech up and running properly. Some exchanges also, if have co-location where with our service we can be closer to the exchange itself. That's where if speed becomes important on the bigger projects, you want to be there. So that's a really important one for the tech side. And then it's a relationship side to actually make sure your project can get listed and they like you and they know the project you work with. Or if the project market maker can't need better fees, so to say, you can help that out, with the proper listing agents at the exchange. Cool. What else do we have? Zhao, thanks for the message. Let me see what I have here. Cool. I think we're here we have is the market maker required if there are no lock-ins? The project is community driven and no VC funded, assuming the token is distributed via airdrops or ICO. Well, market maker is not required, but but it depends on where you go. Like if you go on a DEX only, you can just run with the VC, like with whatever USDT capital you have and tokens, and put in a liquidity pool, and you're done. That's the beauty of it. But if you go on a SEX, it's still especially for smaller projects. Again, it is required to have a market maker. You're not going to get listed without one, and you need consistent liquidity on the books so other people can trade. Like otherwise, you have to rely on someone putting a couple limit orders on and hoping that if they get taken and price moves up, that they get replaced. And it's also for the safety of retail, right? Because if the market is being manipulated, I think it's the market maker's role to make sure that there's a healthy market to trade with. I wouldn't and you've seen examples where I think there was another market maker saying we did this because the valuation was too high and they basically dumped on the DEX. But they're like, market makers should at least control the volatility to some extent. Where if the product really starts to, if there's manipulation happening and there's a pump and dump in action, at least like try as much as possible to get the market back to health, a good health. And it doesn't mean dump the token straight away and you're the dumper, because that gets into like, unethical territory. But you might get unethical practices when you have no market maker on the space and other people trying to manipulate. Especially if there's no liquidity, someone has control over the price. They can do anything and get the wrong people on board, and then they make a huge amount of profit. So you need liquidity as well to reduce the volatility and make sure there's a healthy and fair market other people can participate in. Yeah. Cool. I think that is it, guys. For anyone who is still in, I would say thanks for listening. It was awesome to have you guys. Like I say here, it's been a pleasure. Again, if you're listing manager, a project, VC, an exchange, or an accelerator, definitely reach out. Would love to do masterclasses, liquidity audits, just see how we can help to make sure that you make the right decision when it comes to market making. And I would also say, don't only talk to us. The best thing you can do is talk to 5 market makers, compare them, how they sell on those things that I mentioned before, and make sure we're not the only one to talk to, because that doesn't give you a well-rounded perspective. I would love for another market maker to come in and do a similar presentation, see what they do and how we're actually different. And that's what you should be doing yourself. So don't only talk to us, talk to many out there, get a good perspective, different offers on the table, understand how they work. Maybe you can do a couple trials here and there, some small exchanges to feel out how they work, but don't only talk to us. Same for listing managers. I think it's great if you don't recommend Enflux alone. I think the most fair thing to do is to recommend the person, like 2 or 3 market makers that you can trust, that also give you some commissions, of course, and let them figure it out. Make those intros. Same for VCs. Unless you have worked with one market maker for so long, you've tried out a couple that they're the best, pick one. If that's not the case, I would say slowly recommend a couple, or leave it up to the project to decide which ones to pick. And I think that's how you build meaningful relationships as well, rather than simply go for one. Send the questions in the LinkedIn inbox, and I'm happy to see you at the next webinar.